Hi, it's Suzy Rhoades here with PassMasters. Welcome to this week's Questions of the Week. This week we're going to work on life insurance questions related to Section 4, Retirement and Other Insurance Concepts. Let's get started. Taking an exam from our learning management system. Coco has been covered by a group life insurance policy for the last few years. She has decided to change jobs. Which of the following is true? She will have a specified period of time after she leaves her job to convert, regardless of health. I like that. Let's check the other three. If she chooses to convert to whole life insurance, the premiums will be based upon Coco's original age at the time of employment. She can convert to a policy with a higher face amount, or she can convert from her group life to an individual term insurance policy at any time. There is only one correct answer here, so you click what you believe is the correct answer. You click check answer. You know you got it right if you get that green check mark. You can click show explanation and read the rationale, and you can also listen. Coco has been covered by a... When you have group life insurance, you have the grace period of 31 days to convert to an individual whole life insurance policy. The premium is going to be based upon Coco's current or attained age, regardless of health. She can convert to an individual whole life policy of up to the group term insurance policy's face amount, but she cannot get more than that without a physical exam. All of the following are exceptions to the IRS early withdrawal penalty, which is 10%, except qualified educational expenses, annuitization, $10,000 towards a vacation property or disability. The correct answer, what is not an exception, is $10,000 towards a vacation property. $10,000 towards first-time homebuyer expenses, however, would be an allowable exception to the 10% early withdrawal penalty. Company XYZ purchased a key person life insurance policy on Kate, their director of operations. Shortly thereafter, Kate left Company XYZ and went to work for Company ABC. During her first week at her new job, she died in a car crash. Which of the following is true? The death benefit will be paid to Kate's estate. The death benefit will be paid to Company ABC, that's her new company. The policy is void, or the death benefit will be paid to Company XYZ. So a key person life insurance policy is a policy owned by the business, in this case Company XYZ, purchased on a key person. Just because Kate switched jobs doesn't have any effect on the policy. There was insurable interest at the time of application, which is the only time insurable interest needs to exist. So the death benefit will be paid to Company XYZ. Strange story though. When helping the client to determine the amount of life insurance needed, which is incorrect? The human life value approach looks at the expected earnings remaining in the insured's life and looks to replace them. One of the factors that should be considered is how much of a premium can the insured afford. The capital needs approach looks at the amount of money that would be needed to pay off the house, fund the kids' college educations, pay off debts, and pay for funeral expenses. The least expensive life insurance policy is always the most suitable, with the rest being invested in the stock market. That's the best answer here. So you always have this job of picking the most in this question. Incorrect, because they were looking for the incorrect statement. The best answer. Abraham is covered by a group term life insurance policy at his work. The face amount of coverage is $10,000. If Abraham were to lose his job, he would be able to convert to a policy with which of the following death benefits? $1,500, $5,000, $10,000, or $2,000. Abraham would have 31 days to convert, regardless of health, to a whole life policy. Face amount the same as he had on his group policy. $10,000. He can convert to whole life regardless of health within 31 days based on his current or attained age. Vanessa has a life insurance policy with a $500,000 face amount. She is age 75 and terminally ill. She sells her owner's rights to a third party for less than $500,000. This describes which of the following: an illegal transaction, a life settlement, a viatical settlement, or a long-term care rider. Because of Vanessa's terminal illness, this is a viatical settlement. Corinne has a life insurance policy issued by a mutual insurer. Which of the following statements is true? Interest earned on dividends would not be taxable to Corinne. Any dividends she receives are taxable as ordinary income. Premiums are tax deductible to Corinne. Or death benefits paid to a beneficiary are not taxable. The only one of those statements that is true is death benefits paid to a beneficiary are not taxable. Interest earned on dividends would be taxable as ordinary income to Corinne. Dividends received are viewed as a return of premium and are not taxable because it's a participating policy. Premiums for life insurance on an individual basis are never tax deductible. Which type of rollover eliminates the 20% mandatory income tax withholding? Individual, indirect, complementary, or direct? Which one is paid to the individual? The indirect rollover. Remember, individual, indirect? A direct rollover avoids the 20% mandatory income tax withholding. The 20% mandatory income tax withholding only exists when it is an indirect rollover, where the money is paid to the individual. Let's see how we do. Oh yeah, thank you so much for watching. I hope you learned something. Be sure to give this video a thumbs up, subscribe to our channel, and turn those notifications on. If you have any questions, just ask me in the comments below. If you would like to check out PassMasters course offerings or to enroll in any of our programs, there is a link found in this video's description. Keep up the good work. I hope to have you as a student soon. Happy studies. Study, 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 pass!